Now we are moving on to segment 10, composition scheme. So this is a small topic. Mostly it will be tested in MCQ or somewhere in a connecting provision. It can be given in exam. So composition scheme section 10, we have two types of composition scheme, that is composition scheme under 10.1 and composition scheme under 10.2a. Composition scheme under 10.1 is applicable to manufacturer, trader or supplier of food service provider, whereas 10.2a composition scheme is applicable to manufacturer, trader or any service provider. And section 10.1 composition scheme is applicable if their aggregate turnover during the previous year does not exceed 150 lakhs. In case of specified states, that 8 states, it will be 75 lakhs. What are those 8 states? You remember MMTN, USAM. So Manipur, Mizoram, Tripura, Nagaland, U for Uttarakhand, S for Sikkim, A for Arunachal Pradesh and M for Meghalaya. So this is MMTN, USAM, the limit will be 75 lakhs, whereas other states the limit will be 150 lakhs. If their aggregate turnover, so aggregate turnover should be computed on all India basis. If it exceeds that limit, so then they cannot opt for composition scheme during the current year. So it should not exceed that limit during the previous year. Then current year they can opt for composition scheme. And to whom it is applicable, we know that manufacturer, trader, supplier, food service provider or any other services up to 10% of turnover during the previous year or 5 lakhs, whichever is higher. So primarily they should be manufacturer, trader or supplier, food service provider. In addition to that, they can render any other services. But what is the limit up to which service can be provided? 10% of turnover during previous year or 5 lakhs, whichever is higher. And here it is not aggregate turnover, it is turnover. So turnover always we need to see state-wise. For example, this is the first year in which we commence a business. So previous year turnover is 0. So 0, definitely we can opt for composition scheme current year. And 0 into 10%, 0. So that's why minimum 5 lakhs they have given. 0 or 5 lakhs, whichever is higher. They can render service up to 5 lakhs during the current year. Other than these three, manufacturer, supplier, food service provider, trader, other than these three, any other services they can provide and still they can continue into the composition scheme. What is the benefit of the reduced rates? Suppose if they are a manufacturer, so 1% of total turnover, and they should not make interstate supplies, they should make only intrastate supplies. Therefore, CGST 0.5%, SGST 0.5% on total turnover. Wherever we are using the word turnover, it will be always state-wise. Only in aggregate turnover, it will be on all India basis. So that particular state, total turnover should be taken 0.5 CGST, 0.5 SGST. Trader 0.5 CGST, 0.5 SGST on taxable turnover, not on total turnover. Whereas supplier food service provider 2.5% CGST, 2.5% SGST on total turnover. What about that service provider who is providing service up to 10% limit or 5 lakhs, whichever is higher? So what is the rate? Like a trader only. That is 0.5% CGST, 0.5% SGST on taxable turnover. So on that only they need to pay. This is given in Rule 7. So 1% on total turnover in case of manufacturer, 5% on total turnover in case of service provider, 1% on taxable turnover in case of trader or service provider up to that limit allowed. And current year up to what limit they will be into composition scheme? Up to that 1.5 crores or 75 lakhs. That is 150 lakhs or 1.5 crores, both are same. So 150 lakhs or 75 lakhs during the current year they will be into composition scheme. The moment they cross that turnover during the current year, that is aggregate turnover during the current year, they are disqualified from the composition scheme and they need to go for normal scheme. Then difference in the conditions. So a manufacturer, that is we have one point, that is S9 RCM. So section 10 subsection 2. So there are certain people who cannot opt for composition scheme. That will be 10.2. And these restrictions we need to check for the current year in which the composition scheme is opted. Remember, S9 RCM. So these people cannot opt for composition scheme. Yes, for supply of services other than supply of food or beyond 10% limit, they cannot opt for composition scheme. Then N for non-resident taxable person who is coming from outside India to India, who is not having any physical place of business in India, they cannot go for composition scheme. I for interstate supplier of goods or services, whatever may be the interstate supplies, they cannot go for composition scheme. And another N will be non-taxable supplies, that is alcoholic liquor or petroleum products, they cannot go for composition scheme. E for supply of services. Supplier of goods through e-commerce operator can opt for composition scheme, but supplier of services through e-commerce operator cannot opt for composition scheme. Which e-commerce operator? That e-commerce operator who is liable to deduct TCS. So for example, there is a restaurant which is supplying food through Swiggy. Now in this case, can that restaurant offer composition scheme? Very much yes, because in case of supply of food through Swiggy, Swiggy is not liable to pay TCS because it is covered under 9(5). So whenever 9(5) is applicable, TCS is not applicable. Due to that reason, they can offer composition scheme. If there is a e-commerce operator to whom TCS under section 52 is applicable, and through the e-commerce operator when the supply is made by the service provider, they cannot opt for composition scheme, but the restriction is not there for the goods. Then RCM under section 9 subsection 4, that is, it is applicable right now only in case of promoter or builder who is making purchase from an unregistered person. If they have got some stock on which GST is not yet paid, they cannot go for composition scheme. And see, for casual taxable person who is coming from other state to this state and is not having any physical place of business in this state, cannot offer composition scheme. And last, M, manufacturer of notified goods. What are those notified goods? Ice cream and edible ice, pan masala, tobacco and tobacco products, then aerated waters, bricks and roofing tiles. These are the notified goods. Manufacturer of these notified goods cannot offer composition scheme, but the trader of these notified goods can opt for composition scheme. We don't have any restriction. Again, all these restrictions is during the current year in which composition scheme is opted. Previous year they can make non-taxable supplies. Previous year they can make supply of services through e-commerce operator. Previous year they can make interstate supplies. So that will be counted in the turnover or aggregate turnover. But current year they should not be making all these supplies. If they make, then they are disqualified from the composition scheme. They need to pay GST at the normal rates under normal scheme. So that is this point. When 10(2)(a) is applicable, 10(2)(a) is applicable if aggregate turnover during the previous year does not exceed 50 lakhs, and we don't have any special states or other states like that. All states it will be 50 lakhs, and it is aggregate turnover to be counted on all India basis. And to whom it is applicable? Again, manufacturer, trader, any service provider. So even a beauty parlor can go for composition scheme under 10(2)(a), or a coaching center can go for composition scheme under 10(2)(a). What is the benefit of the reduced rates? 3% CGST and 3% SGST on the total turnover. And again, here also they should not make interstate supplies. That's why you remember it as 6%, but don't write 6% because CGST 3%, SGST 3%. What is the current year limit for the reduced rate? So as and when the aggregate turnover during the current year exceeds 50 lakhs, then they are disqualified from composition scheme under 10(2)(a), and they need to pay under normal scheme. And difference in the condition, there S9 RCM, here 9 RCM, because any service provider can go for 10(2)(a) composition scheme. And one more difference is that manufacturer of notified goods cannot offer composition scheme. Here manufacturer of notified goods as well as supplier of notified services, but those services are not yet notified. So therefore notified goods, pan masala, tobacco, tobacco products, ice cream, edible ice, aerated waters, bricks and roofing tiles, whereas notified service, that is yet to be notified. And these are the special states for which 75 lakhs limit will be applicable, that is MMT and USAM. And is this composition scheme mandatory or optional? Optional. If I am having a benefit, then I will definitely go for the composition scheme. So it is optional, I can decide. But remember, I can opt for composition scheme if I am already registered only in the beginning of the financial year, and during the financial year I cannot enter into the composition scheme. Then if composition scheme under 10(1) is not applicable, then definitely they can go for composition scheme under 10(2)(a). So which means I am a service provider other than supply of food, definitely I can go for 10(2)(a) composition scheme. Or so I am a manufacturer, trader or supplier of food service provider, and I want to render service beyond 10% limit. So then I can definitely go for 10(2)(a), because in 10(2)(a) we don't have any limit for services. Then disadvantages of composition scheme is that they cannot avail ITC on their inward supply. If I am under composition scheme, I cannot take ITC on my inward supplies, as well as the GST what I am paying under composition scheme, that is at 1% or 5% or 6%, I have to pay out of my pocket, and I cannot recover that from my recipient. That's the reason why a person opting for composition scheme will not give tax invoice, but will be giving bill of supply. Suppliers who are making supplies to promoter or builder under 9(4) cannot opt for composition scheme. So there is one restriction here, that is, suppose if I am a supplier and I am making supply of goods or services to whom? To a promoter or builder covered under 9(4). Promoter or builder covered under 9(4) means they are a residential real estate builders. So who is required to pay GST at the rate of 1.5% or 7.5% without ITC, and they have to purchase it from a registered person. If they buy from an unregistered person, then in that case they have to pay GST under RCM. Now whenever I am making sale to them, definitely I cannot go for composition scheme. I should register only under normal scheme. So composition scheme I should not go. Otherwise, rather than paying GST under RCM at the rate of 28% or 18%, they will buy from a person opting for composition scheme, and the composition scheme dealer will pay 1% and they will easily escape from that provision. That's the reason why supplier who is making supply of goods or service to promoter or builder covered under 9(4), so composition scheme cannot be opted. Then GST payable under RCM at the normal rates. For example, I am under composition scheme. I have some inward supplies. On those inward supplies, I need to pay GST under RCM. Now at what rate? Even though I am under composition scheme, I need to pay GST under RCM at the normal rates. So even though they are under composition scheme, at what rates? Normal rates, not at that 1%, etc. and all. Normal rates means the rate applicable to that particular transaction which is covered under RCM. Then what is the meaning of aggregate turnover? Generally aggregate turnover for the purpose of determining registration. So we need to include 4, that is taxable turnover, exempted turnover, non-taxable turnover, zero rated turnover we need to include, and 2 exclusions, that is inward supply covered under RCM and taxes will be excluded from the meaning of aggregate turnover. This is the regular meaning of aggregate turnover, and aggregate turnover will be computed on all India basis. But when it comes to composition scheme chapter, the meaning of aggregate turnover 5+, that is taxable supplies, exempted supplies, non-taxable supplies, zero rated supplies, and pre-registration turnover. So before getting registered, if I have some turnover, that should also be taken into the aggregate turnover here. And thereafter 3- will be there. One is inward supply under RCM, next second one will be taxes, CGST, SGST, IGST, compensation cess, and one more exclusion is that interest on loans, advances, deposits. Suppose if there is any interest on account of delay in receipt of consideration, that is not a separate transaction, that will be included in the value of supply. So therefore we don't have to bother about it, because anyhow it will be added into the value of goods. Whereas interest on loans, advances, deposits, actually it is an exempted service, even though exempted should be included in aggregate turnover, but for the purpose of composition scheme, determination of eligibility to offer composition scheme, interest on loans, advances, deposits should not be included. So these are the 8 points that we need to remember, 5+ and 3-. Then what is turnover in a state or union territory? Because aggregate turnover is decided, like aggregate turnover is important for the purpose of deciding whether composition scheme is applicable or not. Whereas for determining the liability of composition scheme, so we need to take the turnover. So what is the difference between aggregate turnover and turnover? Both are same, but aggregate turnover is computed on all India basis and turnover will be computed state or union territory wise. Then person opting for composition scheme can provide service up to 10% of turnover. Here it is turnover, not aggregate turnover, means turnover in a state or union territory or 5 lakhs, whichever is higher. And while computing this 10% in the turnover, whether we need to take interest on loans, advances, deposits? No. Interest on loans, advances, deposits should not be taken into account. And current year, while counting the 10% limit also, don't count interest income. For example, previous year my turnover is 120 lakhs. Then I can provide service up to 12 lakhs during the current year. So during the current year, I provided normal services 10 lakhs and I have an interest income of 3 lakhs. So total 13 lakhs of services. Is it okay? Yes. Because that 3 lakhs of interest income will not be counted for the current year purpose. Only the 10 lakhs of services will be counted. So interest will not be counted. So which means I can provide service up to 12 lakhs. And what is the service that I have provided? Only 10 lakhs, which means that still I can opt for composition scheme, not at all an issue. Then the tax rate applicable for these services is 1% of taxable turnover. So whatever is the taxable turnover, on that only 1% will be payable. So therefore there is one mistake in the study material question. In a study material question, it is given that they are supplying farm labor. When they are supplying farm labor, actually supply of farm labor is an exempted service, because any service in relation to agriculture or agricultural produce is exempted. Accordingly, supply of farm labor is exempted. But on that also they have computed some 5% like that, which is wrong. So we need to take only taxable turnover. On the taxable turnover only 1% will be applicable, that is 0.5% CGST, 0.5% SGST. Then other procedural provisions, if you see, if I am already registered, I can opt for composition scheme only in the beginning of the financial year. So during the financial year, I cannot opt for composition scheme. What if I am getting registered now only? Then in that case, along with registration application, I can enter into the composition scheme by selecting the option. So during the financial year, anytime I can go into composition scheme, because I will file REG1 and I select the option to go for composition scheme. But if I am already registered, I need to file CMP2. that CMP2 to be filed before commencement of the financial year, as and when the portal is opening up. So at the time only we need to make the application. And then every person who is under composition scheme has to display that they are under composition scheme in every notice, signboard, displayed at the principal place of business and additional place of business. Also in every invoice or other document, they need to mention that they are under composition scheme. And the type of returns that will be filed by a person under composition scheme is quarterly return, because they have to pay tax on a quarterly basis. So they have to file quarterly return by 18th of the month following every quarter. For example, Jan to March quarter by 18th of the April, and April to June quarter by 18th of July. And along with the return in CMP8, they are also required to pay the taxes also accordingly, the composition scheme taxes. And they are required to file an annual return. That annual return will be filed in GSTR4. So for throughout the financial year, next year by 30th June, they need to file GSTR4 annual return containing the details of transaction throughout the year. And that annual return, if they are not filing within 3 months after the due date, so their registration is liable to be cancelled. And next point is that as GST is payable on advances by a person under composition scheme, because section 12 subsection 2 read with notification 66 of 2017 says that a person who is opting for composition scheme or specified actionable claim, the time of supply in case of goods will be due date of invoice, actual date of invoice, or date of payment, whichever is earlier, which means that whenever they collect the advances, they have to pay GST on advances. Due to that reason, whenever a person is computing the composition scheme liability, so under the composition tax liability, first they need to see how much is the bill of supplies raised during the quarter, because a person under composition scheme cannot recover the GST, so the document issued by them will be bill of supply. So they need to see what is the bill of supply raised during the quarter, and then in that bill of supply there will be some advances which would have already been taxed in the previous quarter, so that needs to be deducted. So minus advances received in the previous quarter for which bills are raised in the current quarter, and thereafter we need to add advances received during the current quarter for which bills will be raised in the future quarter. So therefore this adjustment needs to be made. So first bill of supply during the quarter minus advances received during the previous quarter for which bills are raised during the quarter, plus advances received during the current quarter for which bills will be raised in future. This should be taken, this adjustment should be done, and on that only they need to pay tax under composition scheme. Next, all in or all out. That is, if I am having 3 registrations, all the 3 registrations may be within the state or maybe different states, all the 3 registrations will be under composition scheme, or all the 3 registrations will be under normal scheme, but mix and match is not possible. Again, under composition scheme also, suppose 3 registrations, I wanted to go for 2 registrations, composition scheme under 10.1 and another registration composition scheme under 10.2a. It is not possible. So all in or all out is applicable there also. So few registrations under 10.1 and few registrations under 10.2a is also not possible. And next, this particular S9 RCM is same for even 10.2a, except that any service provider can opt for composition scheme. What is the validity of composition levy? If all the conditions are satisfied, option remain valid. Every year we don't have to intimate that we wanted to go for composition scheme. Suppose if the conditions are not satisfied, so then that is maybe we are making interstate supplies or we are making supply of services through e-commerce operator. Whenever we breach the condition or whenever our aggregate turnover exceed that specified limit of 150 lakhs or 75 lakhs or 50 lakhs, we need to exit from the composition scheme. To exit from the composition scheme, we have a window of 7 days. Say for example, today we committed the breach or today the limit has crossed. So from today, within 7 days, we need to exit from the composition scheme by filing CMP4. So whenever we exit from the composition scheme to normal scheme, we can avail the ITZ on closing stock, inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock. As per 18.1c, even capital goods can be taken after reducing 5% for every quarter or part thereof. We can file ITZ1, we can avail the ITZ. So remember, CMP4 is to exit from the composition scheme and ITZ1 is to avail the ITZ in that case. So CMP4 and ITZ1 will be a combo. And next, self-withdraw. So voluntarily also anytime they can withdraw from the composition scheme by filing CMP4. Suppose if they have breached the condition and they continued in the composition scheme without exiting from the composition scheme, then if the officer identifies at a future point of time, the officer will give a notice in CMP5 and thereafter they have to give reply within 15 days, and in CMP6. So CMP7, they will pass an order. That is, officer will pass an order within 30 days from the date of reply. So notice plus 15 days will be reply, and reply plus 30 days, they will pass an order either allowing him to continue in the composition scheme or denying the composition scheme. Suppose If the composition scheme is denied, then in that case, whatever tax which he has already paid will be reduced from the tax that is required to be paid. So far, whenever he exits from the composition scheme, so what is his total liability under regular scheme or normal scheme minus how much you already paid under composition scheme during that period. The differential amount along with interest and penalty will be payable when the composition scheme is denied. Whether the denial of composition scheme is prospective or retrospective, so it can be either prospective or retrospective. It is at the option of the officer. For example, 29th April 2027, when they are denying the composition scheme, maybe that particular date onwards they can deny, or retrospectively also they can deny backdated, but not before the date they committed the breach. Say in 2026 July they committed the breach, so before July they cannot reject the composition scheme or deny the composition scheme. So from July they can deny the composition scheme, even though in 2027 April they are passing the order for denial. So whenever you come out of the composition scheme, we can take the ITC on closing stock. So what is the time limit within which ITC want to be filed? Within 30 days from the date of exit from composition scheme. So form CMP4, that is withdrawal from the scheme, and ITC1, these two is one combo. Intimation within 7 days from occurrence of event, and availment of ITC on closing stock and capital goods within 30 days from the date of conversion. Same way, whenever we enter into the composition scheme, we will file CMP2 before commencement of the financial year. When we enter into the composition scheme, we need to reverse, because so far we were under regular scheme and we enter into composition scheme, we cannot enjoy the ITC. So ITC needs to be reversed as per 18 subsection 4. So that ITC reversal same. So much of the ITC already availed on inputs as such held in stock, inputs in the form of WIP held in stock, inputs in the form of FG held in stock, and on capital goods based on the balance life, we need to reverse the ITC. So this particular ITC to be reversed in ITC 3 form within 60 days from the commencement of the financial year, because only before commencement of the financial year we can go for composition scheme. So 60 days from the commencement of relevant financial year. What if we don't have the balance in ITC? Then we have to make the payment with respect to that. Then CMP5 is a notice, and CMP6 reply to notice within 15 days, CMP7 issue of order within 30 days of receipt of reply, CMP8 is written to be filed by a person opting for composition scheme within 18 days from the end of the quarter. So denial of composition scheme, already we have seen either it can be prospective or retrospective, but not before the date of contravention of provisions. When is it advisable to opt for 10(2)(a)? So whenever 10(1) is not applicable, means if I am a service provider other than supply of food, or if I am a manufacturer, trader or supplier of food, but I want to render services beyond 10% of turnover or 5 lakhs, whichever is higher, I can go for 10(2)(a). And what is the meaning of various turnovers? Because we have come across 3 turnovers. One is aggregate turnover for deciding the eligibility of opting for composition scheme, then turnover for computing 10% limit of services, and turnover for payment of GST under composition scheme. So aggregate turnover will be computed on all India basis, whereas the other 2 turnovers will be computed state-wise. What is the period for which it will be determined? So aggregate turnover will be computed for previous year, even 10% limit also for previous year, whereas turnover for payment of GST under composition scheme we need to check for the current year. And what is the meaning of aggregate turnover? We know that 5 plus. So taxable supplies will be included, exempted will be included, non-taxable will be included, zero rated as well as interstate supplies, everything will be included. But even pre-registration turnover is also included. What is excluded? So inward supplies covered under RCM, then interest on loans, advances, deposits and taxes will be excluded. So this is how we determine the aggregate turnover. Pre-registration turnover means the turnover for the financial year before the date you got registered. Say for example, you come in a business and after 40 lakhs you will register and you will make some sales. So post registration turnover is 110 lakhs and pre-registration turnover is 40 lakhs. So what is your aggregate turnover? 150 lakhs. Like that total aggregate turnover should be taken. Then what is the difference between aggregate turnover for determining the composition scheme eligibility versus turnover for payment of GST or turnover for computing 10% limit? First, for turnover for computing 10% limit, we need to take state-wise turnover. We should not take all India basis. Rest of the information will be ditto, copy paste. Then, what is the turnover for payment of GST under composition scheme? So, in this case, from turnover for payment of GST under composition scheme versus the turnover for computing 10% limit, the changes you need to appreciate. So this we need to see for the current year, that is for previous year, and state-wise only both. And you should not be making interstate supplies, or you should not be having exports, zero rated supplies or non-taxable supplies during the current year, because during the current year when you're opting for composition scheme, if you make interstate supplies or zero rated export etc and all, or non-taxable supplies, you're disqualified from the composition scheme due to that reason. And even pre-registration turnover will be excluded, because pre-registration turnover, now you're not registered, so you don't have the liability, and after registration you will have the liability. Say for example, this year I commence a business and up to 40 lakhs I am not required to register, and thereafter if I am under 10(1), overall 150 lakhs, first 40 lakhs no need to pay GST, remaining 110 lakhs I need to pay GST at the rate of 1%. The moment I cross 150 lakhs I need to pay GST at the normal rate, like that. Okay, so first the total turnover given in the question you divide into two: turnover under composition scheme, turnover under normal scheme. Turnover under composition scheme minus pre-registration turnover, you will be having the remaining amount, that will be the turnover on which GST payable under composition scheme. So beyond 150 lakhs, whatever is there, that is under normal scheme. The same provision is even applicable in case of 10(2)(a). Okay, and not applicable means what? These supplies cannot be made during the current year, and even if it is made, the person is disqualified from the composition scheme. One important point you need to remember, which is a contradicting point from study material, is that so whenever you are under composition scheme, when you rent under 10(1) and when you render the services, so up to 10% limit, the rate applicable is 1% of taxable turnover. That's the only place there is a contradiction. So with this, we completed composition scheme.